welcome to another episode. Today I am joined by Sam, who's the founder at Mach, and he's building another bridge, which we can maybe get into a bit later because he does not agree that it's a bridge. So Sam and I have been talking to each other over DMs for the last few months, talking about solvers, intents, and bridges in general. And I really appreciate his thoughts around the whole ecosystem. So I'm really looking forward to this conversation.
Yeah, Arjun, thanks for having me. I'm a huge fan of the podcast, and I'm excited to be able to help explain a few things about what we're building.
Awesome. I would love to just get started with a quick intro about how you got into crypto. What's your background and expertise?
Yeah. So I was studying computer science at Stanford, and before Stanford, I built and sold gaming desktops, which is like a weird side business. So I brought a couple of gaming desktops with me to college, and I didn't have time to game. It'd be kind of irresponsible to spend my time here playing video games. I had some friends who went to MIT, so I actually learned about Bitcoin through the MIT Bitcoin experiment. They just gave every MIT student a bunch of Bitcoin at one point, just because they wanted to try to jumpstart crypto usage. You can kind of view it as the first airdrop, really. But yeah, so we had free energy because it was dorm room, and so I decided to turn all these desktops into Bitcoin miners, much to my roommate's chagrin. And then from there,
I feel like a lot of people just get started with crypto and Bitcoin in colleges. Maybe it's just something about that age, or everyone's just getting introduced to finance and crypto in general. But yeah, you were talking about how you got started with mining Bitcoin in college.
Yeah, no, and it's I think it was very aspirational. I think the message of Bitcoin, something that I think the space has actually gotten worse at, where there's not enough discourse around what the space looks like 5-10 years from now. It's all kind of become more nihilistic. But at the time, Bitcoin, the promise of self-sovereign money that you could run on a desktop in your dorm room was something that I think appealed to a lot of people. But from there, I went to started doing a lot of stuff in ETH, and yeah, prior to this was mostly just doing investing, but we developed a high degree of conviction around what the future of decentralized liquidity was going to look like, and are mostly just focused on building towards that.
Awesome. And then, so you went from Bitcoin to Ethereum. I feel like that's the general path most people in crypto take. But then now you're building in Interop, right? So, what is the opportunity that you see in Interop today that makes you feel like, okay, I have to build a project to solve some of these problems today?
So we're mostly building actually in I would call it the liquidity space. We view ourselves as building a crypto exchange, and we're mostly a lot of our engineering efforts going into using trust execution environments, among other approaches, to just create a low latency private platform, a more fair platform. Interop, we're here at Interop because to some extent no one else is. It's a space that's very broken, where it's very, very hard, if not impossible, to do a swap from native Bitcoin to Solana, especially in size. And so from our perspective, we're here because we need order flow. Most exchanges live or die by getting order flow. And there are orders that are not being filled well today that we believe we can fill.
Okay. So would you say this about the EVM market? Because I feel like the EVM landscape is much more competitive, right? Like the example that you gave for native Bitcoin to Solana, there are probably 2 bridges out there that serve this. Or if you look at EVM to Bitcoin, there are probably 5 bridges that can do this. But I feel like within the EVM zone, there are a lot more bridges. And that's where you guys have also started. That's where I feel like every liquidity solution starts today.
Sure. We don't really view ourselves as a bridge. A pretty small fraction of our volume today is actually what you'd call bridging. Our focus has mostly been cross-chain swaps, because to your point, the bridging market is incredibly saturated. CCTP is really, really good and getting faster. The only reason, if there's no way to compete with CCTP. They have infinite depth, and it's priced at spot, it's priced at dollar on both sides, and it's the issuer. If you're going to hold USDC, you intrinsically trust Circle, and so there's no risk. And so perfect pricing, infinite depth with zero risk it's a very I'm not sure how you beat that unless you try to go negative on rebates. And you have these standards layer 0's OFT that are a lot of projects are kind of there's a lot of people allowing projects themselves to become essentially their own CCTPs. And so like we don't really view bridging like we don't really view ourselves as playing in the bridging space where we're a large consumer of bridges. We actually, because we have to rebalance. We have to rebalance our positions between chains, and so we end up using CCTV quite a bit. And we'll use whoever's cheapest. We also use Binance quite a bit for rebalancing, because you can basically use Binance as a CCTV for Tether, where you put Tether in on one chain, take Tether out on another chain. Most of our volume is these cross-chain swaps. Like, look, no one is actually, no consumer, no end user is actually using bridging. Like, they're using bridging as kind of part of a broader. I was going to use the word intense, but we can get into that in a second. But they're using bridging as to help accomplish like a broader goal, right? Like, no one cares deeply about holding USDC on one chain versus another chain, and so they're typically starting from something else and going somewhere else. In the same way that if you fly from one airport to another airport, you're not starting at the airport and ending at the airport. You're usually trying to get to some destination near the airport. And our value proposition here is letting users go point to point in one click instantly.
Makes sense.
So
I mean, yeah, I feel like that's the perfect analogy, right? Like all the bridges serve a purpose for a user to kind of get to a new ecosystem and explore it, right? Or let's say you want to buy a meme coin on Base, so you have to get to Base first and then look for another DEX or an aggregator, right? So that's why even on the LeFi and Jumper side, we connected bridges with DEXs to unlock the cross-chain swaps functionality. So I feel like you're building the same thing but on a bridge level. So that's is that the right way to put it?
totally, yes. Like, we exist for the same reason you exist, because like bridges are ultimately just infrastructure, and we're building at the infrastructure layer. Like, we're focused very deeply on improving liquidity, because like going back to our like the entire reason we're in the Interop space, like we just want the order flow. And yeah, like if users simply wanted to move USDC from one chain to another, like nothing in the space would exist besides CCTV. And that's not what they want. They want to do more things, and which is like what. And you guys have helped. You were one of the first projects to realize this, and have made DeFi a much better place for most end users.
Makes sense. And would you say that token standard like OFT or entity or like WOP tokens, how do they fit into this thesis of yours? Because let's say if CCTP is this like minter for USDC, token wrappers can do it for any token, right? So what role do token frameworks play in this ecosystem that you're explaining today?
It's going to be interesting to see. Like, I actually haven't done. I mean, generally these sorts of things, my preference would be to kind of spend a couple of days running numbers on them to come up with like a hard opinion, which isn't like a good use of time for me. What I suspect is things like CCP rely on the asset having liquidity inside both, on both chains, right? So CCTP, if USDC weren't liquid on one of the chains that CCTP were on, it wouldn't be useful as a bridge. It'd be like an airport that was 7 hours away from the city that you were trying to get to, because the actual like slippage from getting from the asset into the other asset would be too great. And so like CCTP is specifically useful specifically because USDC is one of the most liquid assets in crypto. I think you'll see diminishing returns with other projects like rolling things like this out. Like Tether could probably do it, and probably ETH, but beyond those assets, it's much less useful because it's much less useful as the liquidity isn't there. It's very useful locally for the projects themselves, because what it allows like a project to do is have the liquidity live on one chain. So if I'm issuing a new asset, let's just say Sam coin, and we adopt like the OFT standard, we can have like a really deep pool on, let's say, like Arbitrum, and then essentially solvers can do arbitrage between this pool to fill orders on like optimism for my asset. So I think we'll see some use cases there, but like I don't really ever seeing it rival like things like CCTP, because most of these people, like the unique characteristic there is just like circles liquidity.
Makes sense. I mean, like you can probably bridge to another chain, but if that chain does not have a market for that asset, like what are you going to do with it? You can just maybe get
Exactly.
exposure to that asset on the new chain, right? But like you brought up solvers in that point, so I feel like even for solvers and their inventories, maybe this could be useful because they technically do not want to hold all of these long tail assets, right? So they can just bridge to different chains using these token frameworks and not necessarily hold these assets in their inventory.
So we're doing a lot of work here actually, just because it's something that's super interesting, and it's something that I think people just don't understand how things with the OT, well, they don't really understand the impact of things with the OT standard. RWA projects are very well positioned to do things like CCTP because there's no risk, right? The issuer already has mint and redeem abilities, and anyone holding the asset trusts those to be well managed. If you and I go and buy like a tokenized treasury, we are trusting that the issuer is not going to kind of just smash print Jerome Powell style, or just basically, and that they'll like give us money when we redeem them. And so since we're already going to trust the issuer's management of that button, things like CCTP add zero risk. A challenge for a lot of these people today is that they can't add new chains without further fragmenting liquidity because they're all relying on AMMs. And so when you turn on a new chain, you have to get enough money in a pool. That caps the largest trade you can do locally. And so something that we've been doing on the solving side with some of these projects is basically aggregating all the liquidity across all chains and using the AMM on one chain, as well as like the OFT standards, to fill orders on a chain that's not necessarily even it's not necessarily even the origination or destination chain. So you can place an order on like Arbitrum, we might fill on ETH, and you might get the end assets on Optimism. And what this does for RWA projects is allows them to do way more chains much more quickly with much better liquidity.
Got it. And for the solvers, does that change anything, like the standards?
They have to have them integrated, and they have to like trust them basically, right? Because like what we do all the beauty of intents, like one of the things that we view as really cool with intents is you can do things asynchronously. Like this is where the airline analogy falls apart, but we can get you from like point A to point B, then actually kind of do all the rebalancing ex post facto. So we can get you there and like actually kind of use the actual airlines to eventually rebalance ex post facto. And so I don't think the standards matter a ton. Like the actual price of operating them and the risk involved is something that like solvers have to be aware of. But I don't really believe the actual standards end up mattering that much. The other challenge is like they have to get like big enough for it to make sense for outside parties to actually integrate, because there's essentially CapEx involved in every integration. Sorry, let me not use lingo. It takes work, it takes engineering hours to like integrate and test something if you're going to run a lot of money through it, because if it breaks, you lose a lot of money.
Yeah, definitely. I mean that makes sense. And I kind of want to go into like Mach now and what you guys are building. So maybe you can describe the architecture of your protocol and how do you enable this exchange, I would say, or like cross-chain swaps across all of these chains.
Sure. Yeah. So it's actually Mach. Like it's named after like the speed of sound, because we wanted to emphasize how how fast it is. Our average fill time is like about 12 seconds, like across all chains. Yeah. So architecture, the core thing beneath Mach is what we call optimistic escrow. And it's not terribly different from how like any of the optimistic rollups work. We tend to view something we tend to view things like optimistic architecture as like a framework that can be applied rather than just kind of a specific thing. So like this is a tangent, but like we don't really view the ZK optimistic like fight as being a little bit fake in that sense, because like you should be using optimistic architectures like wherever you can, because it allows you to go faster, cheaper. In our case, it allows us to basically have the security of cross-chain messaging without doing any cross-chain messaging. It's very similar to how Visa works, the credit card processing network, actually, where the fact that you can do a chargeback means you don't have to do chargebacks. There's probably people listening to this who've never done a chargeback in their life, but the fact that you can do a chargeback is like what motivates the merchants to behave well. Because otherwise, whenever you spend money anywhere, the merchant can just basically add a couple of zeros. And this happens at points where merchants will be like, oh, you spent $100, well, I'm gonna make that $10,000. And when that happens, you can just call up your bank and they can just say, yeah, no, it didn't happen. And they claw the money back from the merchant. And what's cool about this is it allows you to have very, very high security without actually having the cost and slowness of doing a cross-chain message every transaction, because we only do them as part of the challenging mechanism, which ends up letting us be both cheaper and faster than everything else.
Got it. So it's optimistic in the way that everything passes through your protocol, and then only when it's challenged, you actually bring in a messaging protocol like layer 0 to verify the claims of all the different parties, right?
Exactly. So the average transaction has 0 corruption messages, and this is safe and works really well because when you place a trade, your side of the trade is held by the protocol until a challenge window expires. And so up until that challenge window expires, anyone anywhere who thinks that you didn't get what you bought can initiate a challenge, which reverts the money back to you if the challenge passes. And the challenge is like very straightforward. It just basically takes state from the destination chain and passes up to the origination chain. And it's like, and in that, it's in the origination train assesses whether or not the state indicates that you were paid out. And if you weren't paid out, you get your money back. And it's a very, very safe mechanism. Like we have some liveness risk, obviously, with layer 0 and the chains, but you really can't do bridging without liveness risk somewhere. And it's incredibly fast and cheap because like our fillers, the solvers can pay out like as soon as they're confident that like the taker order, like the taker liquidity is landed.
Got it. And out of curiosity, like, have there been any challenges till now?
No, but weirdly enough, there also haven't been like, I think there was one set of challenges once on one optimism block.
Got
Like
it. And like,
challenges are, from a game theory standpoint, challenges are like lighting money on fire, right? Because like the entire point of challenges is that it's negative EV to do bad challenges. Otherwise, you could just grief the system. And so like there actually haven't been. We're going to basically make challenges happen for testing purposes. But yeah, as of now, there's been none that have actually like been initiated.
it's kind of like your credit card example again, right? Like it's basically a loss for the market makers as well to grief any users. So there's no point of like committing a fraud in that sense. And even the economic security of Ethereum is kind of like that, where you're making the attack so expensive that even if someone wants to do the attack, they have to think twice, or they have to put in like $25 billion dollars at stake.
Exactly. No, this is in a proof of stake world. There is like the reason we did this and the reason it's going to become the norm for these kind of transactions is because we live in a proof of stake world, right? Like to your point, which is a very good point. The underlying assumptions here are the same ones that make proof of stake viable. Like if you don't really believe in the economic security of this model, like you probably should also be pretty skeptical of proof of stake.
Makes sense. I mean, it's kind of interesting because like before this whole intense marketing or like the intense meta kind of began, even across was an optimistic oracle system, right? Like that was the branding. So if you look at it, like for the first 2 years, I've always looked at across as an optimistic system. It's only now that everyone has started like using the intense terminology that you start thinking about intense as cheap and fast, or like as fillers kind of putting up their money on the destination chain and the whole process happening.
Totally. Now, when Across has been, they've been like they've done a lot to drive basically all the narratives forward around this, and like they're the one they really basically set the bar in terms of like UX and transaction speed. Like a lot of what we track in terms of like a lot of what we view as like the standard now in terms of like how fast you want to be is it faster than Across?
Makes sense. I think so. What it sounds like is that you're building for a few key features, right? Like one is definitely speed. The other is a byproduct of that, which is like a faster UX, and then a reduced number of clicks as well, right? So is this basically why you kind of picked intents over the pool-based bridging design?
Yeah, I mean the pool-based bridging design like that's been on. So let's take a step back. We believe that anyone anywhere should be able to, in a single click, get exposure to any asset on any chain. And you can't do that today. And no one's really been trying to solve this problem. Like you have people building bridges, you have people like just kind of working on pieces, but no, there's not really anyone who's trying to go to the average crypto person and say, click here, get what you want, where you want now. Like, and that's like, it's a surprisingly empty playing field. Going back to pools, like pools are really, really good for a handful of things. I think the reason pools, and this is like stuff that like I don't think there's a consensus around these positions yet, but what makes pools super powerful is their liveness is basically perfect. If the chain is up, the pool is up, and that's a huge issue with like solving an intents. They have like a price oracle built in, and like pricing is really, really hard. Like that's also another huge issue with like solving an intents. And lastly, you can basically tap third-party liquidity in pools in ways which you really can't do easily with any other system. And so like that's what made pools, like that's sort of like why pools are sort of the foundation layer of liquidity. And once again, like going back to bridges, we don't really view what we're building or intents in general as being competitive with pools. Like a lot of the time, we will actually use pools to fill orders. And so we just view us as kind of an option layer on top, where if we can do it better using other liquidity, we will, but otherwise we'll still tap pools. There definitely isn't room for like anyone else doing anything in pools in the bridging space. And they're also pretty bad for bridging because of like the amount of risk involved. There's like way more money at risk with the pool-based systems, but we can go into that in a second.
So, I mean, like you mentioned, liveness is definitely one of the main benefits of pools, right? Like, if there is enough liquidity in the pool and there's a bridging transaction, that liquidity will participate in that bridging transaction. Like, it's not an either or. That transaction will go through if there's enough liquidity. But I feel like with intents and solvers, it's always on the solvers. Like, they always have a choice, right? So, what happens in a black swan event where like there's so much volatility and is just not favorable for the solvers to actually participate? Do you think like there's a scenario where the solver's liquidity just does not participate in fulfilling any of these orders?
That's a great question. And I think this is something that we view as a huge issue with like all the intense landscape today. I want to take a step back. Pools were always a weird choice for bridging, partially because like you're dealing with much more liveness risk. Where liveness is like much more complex in a cross-chain context because you have like liveness on both chains as well as however you're essentially resolving conflicts between the chains. And so like your liveness is kind of always going to be perfect. Liveness involves like a lot of risk on the cross-chain side, and using a pool makes that even worse because there's much more money at stake because you have to have enough money on both sides to cover your max transaction side. I think the reason pools are heavily used is it like allow people to crowdsource capital, but I think pools are the benefits I laid out are like much less expressed in a cross-chain context. The problem with solving today is that there aren't any solvers. Like you have some fillers in like the single chain RFQ systems, like Flow is doing a great job here, but they're not really doing a lot of cross-chain work yet. And the cross-chain like solving market is, if you don't include bridging, which like we sort of view as very easy, like you are essentially just rebalancing things like ETH or USDC from different chains. So if you ignore bridging, like the market is probably under like 25 mil a day in terms of the actual volume. And a lot of this is like very low quality like order flow. And so this market just doesn't really exist yet. Is our first criticism. The liveness is going to be bad. Like you have to, and like I think people aren't really thinking through this. Like I think the OFA, so order flow auctions, are something that people are very enthusiastic about. We're in this like neat part of history where like MEV and solving are starting to converge. So like both sides are using, like both people in the intense landscape and people in the MEV landscape are now talking quite a bit about order flow auctions. These are going to be really, really bad for liveness because like what you're going to see is whenever volatility spikes, the depth in your system is just going to go to zero because there's way more risk for a filler to give a quote. And they have more money they can make with their capital elsewhere. Like the returns, whenever volatility goes up, the amount of money you can make on Binance, just doing momentum-based trading and so forth, also goes up. And so there's more competition for the capital and there's more risk in actually filling. And so, yeah, I think you hit the nail on the head there with like liveness being the main reason most of these systems will probably suck for users for a long time.
Got it. And I feel like we haven't seen this happen yet, so nobody actually knows what it looks like. But imagine like on any of the intent-based bridges, there are basically no routes, and you can only use pools at that point. I feel like I don't know how crypto Twitter would react to something like that.
Yeah, well, I think we're living pretty far in the future, right? We're still pretty far away from this. Like if you look at like so D-Bridge, its filling is mostly DeFi. So you also have the fact that the vast majority of solvers are essentially like run by their own team. So like Across is the biggest solver inside Across. People complain about this. I think it's actually good in the sense that like solving is really hard. And so like you have to relying on third parties to do all the real work is just like not a viable approach to building a scalable business. Like if I were to open a store and we're like relying on customers to bring things on the shelves and sell, like my store wouldn't really stay in business that long. And so like everything we're talking about is like probably pretty far in the future, but I think kind of what we want to talk about on podcasts. Like if the next steps are going to be bringing in liquidity that's not DeFi liquidity, because I like having an intense-based system where you're just using DeFi to solve is not any different than what you guys offer. And you guys are like lower risk because, or you guys have like, Jumper's like less complex there than basically having a third-party solver like do it and take the risk. But I mean, to put that differently, Jumper for a user is probably better than dBridge today, just because the liquidity sources are the same, and you guys presumably have broader integrations than they do on the solving side. And that's because since the solver there has to basically front the capital, they're taking more risk than you guys take because you're giving transactions for the user to sign. And so you need to basically have differentiated liquidity, which typically is going to mean CeFi or like off-market liquidity for the intent-based systems to really actually ever outperform something like Jumper. We're doing a lot of work integrating like RWA minting and redeeming. So like when you trade into us, we'll be able to basically, like most of the RWAs have USDC mint redeems. Real world assets are essentially tokenized versions of typically existing financial instruments. But you can basically convert these into USDC instantly for free off chain if you have accounts with the issuers. And we've been setting these accounts up because for us, it allows us to basically turn Jumper into CCTV.
Got it. Can you like dive a bit deeper into that, because I don't think I got it fully. So you have accounts with all of these issuers, and then how does that work? Like maybe just explain it like I'm five.
Sure. Sorry, I know we covered a lot there. So a lot of solving today is basically using DeFi sources in most platforms. This isn't that competitive. It's more competitive than basically using intents only for bridging. But it's not that much better than the Jumper, which is like the status quo, because you guys can also give any user access to all the DeFi liquidity sources and can do so with less net risk being taken. Where things can get much more interesting is if solvers have access to Binance and if they have access to all the accounts with all the issuers to rebalance between the issuers. When we started working on this, we had actually I'll just skip that entire tangent. Most of these issuers allow you to basically mint or redeem via USDC. So if you place an order for like Ondo, which Ondo's it's a tokenized treasury, they're a portfolio company of mine, so I'm going to shill them like whenever I get the chance to. And Nate over there is just great, just like very, very like a forward-looking thinker. But if you were to place an order for USDY, which is like a tokenized treasury, and you were to do it through a normal platform today, what would happen is like it would basically route the order through a pool. You would be taking, like you would have to kind of cover the fees on the pool. You'd have to basically incur slippage if your order is large versus the size of the pool. And a lot like Ondo on a lot of chains has like very, very small pools. Like the liquidity is pretty bad. If you were to place an order through our system for USDY, soon will come online ideally in a matter of days. But if you were to place an order for USDY on our system, what will happen is the solver will go to Ondo, send them USDC, and receive USDY on the target chain. It's akin to the value proposition of OFT or CCTV. And this allows us to essentially process this. This won't happen instantaneously. Like we'll have to kind of do this transaction more slowly because we have to like basically go do some work with Ondo. But we'd be able to offer like infinite depth at spot, which you can't do without basically using off-chain liquidity. So you'd be able to do, the pool size is like, let's say 100 million. You'd still be able to do assuming our solver has enough depth to do like the front view at the USDC, we'd be able to do like however much money our solver has. So if our solver has 250 million, we can do a $250 million order at spot, which is impossible to do with a $100 million pool.
And this is for like any real world asset where you can just tap into the actual issuer and get USDC off chain. Pretty much.
If the issuer supports instantaneous mint redeems. So if the issuer basically has money wires, like this wouldn't work on the weekend. Ultimately, though, this all gets expressed in the spreads. So like what's interesting with this is all we're really doing is disintermediation. If you look at like Ondo pools today, they're relying on arbitrage they're relying on arbitrage between people who can issue and redeem, and the pool itself to rebalance the pool. So like you're still basically trading into the issuer, but you're doing so with more extra steps and extra fees than you would do if you're using our system. So if you do 100 million, if you go back to that order, right? So you want to place, you go buy, it's a $100 million pool, you can do a $50 million order. So your plan is just kind of do it in chunks. You fire 50 million because of slippage and how pricing curves work. That really warps the price. And then you have to kind of just go wait until like a market maker goes and like mints more onto to rebalance the pool. Then you can fire an next 50 million. And you're looking at just massive losses because you're incurring a lot of slippage. The market maker is clipping the slippage to like make the fees. You're paying pool fees. The market maker also like needs to basically get paid for the capital they're using to cycle this. And so like what we're doing is just basically cutting all that out. Like the pool is adding zero value in this transaction to you. And so we're just removing it and giving you the same accessibility and safety guarantees as the pool gives you, in the sense that like you get what you bought, you get your money back because of the optimistic escrow system. And you don't need to go through like KYC to touch us.
Got it. And you're saying that only your protocol can do this today because you guys have kind of figured out this workflow, right? Like off-chain workflow that's unique to your solver in a way.
Yeah, so we generally, everything in Tintsland can probably do things. Like, you can definitely make architectural decisions that basically block you from doing this, but we expect this to be like the norm for things like Uniswap X as well. Our edge today is that we've gone and done the work on the solving side. Like we've gone and like talked to a lot of these teams. We've put probably 2 hours into like engineering on the solving side for every hour we put into building the protocol. Because like that's kind of where the actual pain point is today.
Got it. Makes sense. And like I feel like you've worked a lot with solvers in just bootstrapping your protocol, right? So what has your experience been just trying to get one more solvers onto the protocol, and how your order flow is distributed across all of these different solvers?
Yeah, so I think what's interesting with solving, and there's not enough discourse around this, I think, on crypto Twitter. It's really a chicken and egg problem. Like, if they wanted to, they would. Like, if you have like 5 mil a day and like high quality order flow, people will come and take that order flow. The issue is today, the order flow that's hitting the intent-based systems is not basically people trying to pay 30 bips to buy Dogecoin. Like Robinhood charges 30 bips to buy Dogecoin. And that's not really who's using intense protocols right now. It tends to be like very sophisticated groups who are very margin sensitive, who are focused on like low margin pairs. And like going back to kind of the point I was making earlier, like the net amount of like order flow in the space today is like 25 million. We think it's going to go up. We're here because we're here to make it go up. We think there's like a chicken and egg problem in terms of like no one's going to place orders into a system that doesn't actually have like liquidity. And so we think by providing liquidity, we can get order flows to go up. But the solvers will come once there actually is order flow worth filling, which there really isn't today. Like stable order flow is like you probably need a yard of $1 billion of like stable order flow for it to be worth like a third-party solver to actually fill, because the margins on that are just non-existent. But to give some real numbers, I think most outside solvers want to be able to make something like $250,000 a day and like net profit off a pretty small amount of money to actually solve inside a system. And if you go like look at the numbers people are doing, that's like we're nowhere close to basically being able to like sustain like grown-ups playing in that space.
Makes sense. I mean, I think I was talking to Vishwa earlier on this podcast, and he has a lot of experience just running a solver, right? So he was also saying the same thing, whereas like there's not enough order flow or incentive for the sophisticated market makers to come in, and that's why the same chain swap market is just so much more attractive, and you see more competition there because the size there is at least 50x to 100x to compared to like a bridging or like a cross chain swap market.
In our opinion, people are looking at this wrong. It's not even about like volume. It's mostly about the amount of revenue that solvers can make. Like solvers are supposed to be. We like to talk about like economic agents and so forth. Like we like to kind of talk about all this like game theory. But at the end of the day, like the belief is that solvers should be economically independent actors, and for them to be economically independent, they have to basically make enough money for it to be worth their time. And like that's not the case today, and it likely won't be ever the case with basically bridging. I don't think in a world where CCTP exists, I don't think you can basically charge enough money on moving one asset from one chain to the same asset on another chain to ever justify like a third party like group of smart people to spend their time working on optimizing that problem, because like the margins just aren't going to be there. Like there have to be reasonable margins. And what you will see, like what we expect to see is like exotic pairs essentially like subsidize non-exotic pairs in our system. So some solver might do USDC to USDT because they're already here, but where they're really making the money is like Tether on Tron to like WIF. But there has to be like it's not clear to us that a lot of like solving activities that people are trying to like a lot of the needs that people are trying to fill here are really even economically viable longer term.
But then, like, what would be a sustainable business model for some of these intent-based bridges that do just bridging, right? Like, as you mentioned correctly, in the early days, the market is asymmetric, so maybe you can make enough money on simple bridging transactions. But then the actual money to be made is on the exotic pairs where people want to buy meme coins on different chains, right? But then the meme coins are only being served right now with DEXs and not through solving, right? So how do these bridges kind of find a sustainable revenue model in that sense?
No, it's a great question. I think it's a question more people should be asking. I think what you have to do, I mean, and this is our like this is yeah like I mean the very very short answer is I'm not sure they can. Like I think it's a I don't think it's a pressing issue because I think a lot of the solving is in house, but like I don't think without I do think basically incentives are the only way a lot of these platforms can decentralize solving today. And I think that's kind of a bad decision to do because like you really don't want to subsidize activity that will never become like economically viable, right? Like we've seen a lot of this. There's been like a lot of ZERPs, basically like zero interest rate phenomena in our life, where like big tech like finances things that just are completely not sustainable. And if there's not a path towards solving in a specific bridge being something that can actually stand on its own 2 feet eventually, subsidizing it seems like just a bad use of resources. It's just like lighting money on fire, essentially. Where we think intense, this is like not something that's like widely believed, I don't think today. But where we think intense will work is where there's a very large gap between what the cost structure of the most sophisticated user and the cost structure of the average user. Because what you're really doing is essentially licensing, what you're really doing is like licensing skills. There's this like anecdotal story. It's probably false, but there's this anecdotal story about like I think it was Henry Ford and Edison or Tesla. I can't remember which. I'll comment whichever one it was. Where like there's a problem in one of their plants, and let's just say it was Edison. Edison walks into the plant for like and immediately just goes to a specific piece of machinery and takes a piece of chalk out of his pocket, draws a circle on this, and says, "This is what you need to fix." And Ford is ecstatic, asks him to send him the bill. He sends him a bill for like $100,000, and Ford like is incredibly upset. He's like, "It took you 5 minutes to like just write with chalk on a piece of equipment." And Edison comes back with, "But it took me 10 years to basically know where to actually mark on the machine." And so solving is like this. Like solving is highly specialized, reasonably easy for the solvers once they have the infrastructure up, but very, very hard for the average person. Like Ford could have gone around with the chalk, like marking every piece of equipment, and like it would have taken him years to basically know where the actual issue was. And so that's kind of where we see solving basically creating value for users longer term. It's not really clear that bridging's like that, because like I can go fire $1 billion through CCTP and then swap via Uniswap into ETH today with like minimal slippage. And so the value add of bridging is just completely based on that gap. Or sorry, solving is based on that gap.
Got it. Makes sense. And I mean that's the perfect analogy, right? Like the solvers know how to solve, but like they've worked a lot on building this infrastructure, and there needs to be a sustainable business model for them to kind of stay active in the protocol.
the gap has to be large between what the average user can do, like the default path, and basically the solvers, like what the solver can bring to the table.
From your experience, like how many solvers can actually uh, be active in an intent-based protocol and find sustainable profits over a long term?
We're doing things here to actually help fix this. What you're like, so I think the real issue that's upstream of the question you're asking is these order flow auctions, where essentially like the main way that orders getting allocated inside the system today is via auction. So like if we're both solvers and we go into like Uniswap X, we're bidding against each other to actually fill orders. There are a lot of issues with order flow auctions in our opinion, and we don't think it's going to be what's best for the ecosystem longer term. Part of the issue, I think one of the reasons solving today is very broken is because these auctions basically extract all the value from, like they damage solver margins, which we view as a problem. Like we can worry about the solvers making too much money when they're making any money. And so we think it's a bit premature to basically focus on this. It also, to your point, needs some like a high degree of solver concentration, which we also think is bad because we think it damages uptime. Like if you only have one solver, if I'm solving 95% if I'm an outside solver solving 95% of a of the order flow hitting a system, if I just decide to turn my system off, the liveness goes away. One thing I want to mention here, like this is one of the reasons that like internal solvers are actually really good, because like across solvers aligned with it's aligned with across in terms of like keeping uptime. So like across would be a worse platform if across weren't doing the solving, because the solver concentration risk goes way up, because the solver should turn off all of liquidity the very second they find a place where they can make a single BIP more a day. So we think the core problem here is really the auctions, where we think they end up leading to worse outcomes for users. We think they end up leading to a high degree of concentration among solvers. And we think they also reduce solver margins, which like leads to fewer solvers being like willing to invest in actually participating in these systems.
And when you say like you see a problem with the auctions, what exactly about the auctions? Like, is it the first come first serve dynamic or anything else about it?
Sure. Yeah. So take a step back. With any intense platform, you need to have some logic for determining like which solver gets to fill which intent. What the default here has always been an auction, like in every system. You have to kind of make a lot of really weird decisions around like how you're weighing like a lot of other factors, but the default form of approaching this problem has been auctions. We tend to view the intent and solving space as adjacent, if not the same, as the RFQ space. And so the RFQ space is basically like much further down. They're much more mature so far than like cross-chain intents, because you've had things like hash flow that have been alive for a long time, Mach, Uniswap X. And so they've had to basically, there's been much more exploration. CalSwap too. Like I think you can view CalSwap as RFQ. I'm not sure if they call themselves RFQ. But there's been much more experimentation here and much more kind of thought about basically trade-offs and how to handle these auctions. Because you're already weighing things like what are the odds, like what are the penalties for abandoning it, for like not honoring a quote? How do we weigh like time versus price? When do things become binding? And then also the information flow, a huge challenge. None of these systems are open. So the reason Uniswap X is permissioned, although I don't know if they like using that word, but the reason Uniswap X is permissioned is because otherwise, like you and I could just go and like watch the orders coming in and essentially front run on Binance to basically capture the price impact of the order to extract value from Uniswap X's users. And the vast majority of these systems today are essentially permissioned, which is an interesting choice because it has like fairly negative regulatory implications, but it's probably also one of the reasons we just haven't really seen an RFQ become bigger than it is. So to answer much more concretely, RFQ systems, we expect basically cross-chain intents to like follow the path of the RFQ systems because they're just very, very similar at the end of the day. With the RFQ systems today, what you generally see is like 4 or 5 people bidding for each order, and generally speaking, this leads to a lot of concentration because generally speaking, one group, whoever has basically the lowest price structure and like integrated first, just tends to end up owning all the flow for that platform.
Got it. I think that makes perfect sense, right? Because like auctions are a byproduct of intents, at least in the bridging world, I feel. And a lot of these teams are not used to running auctions, but they have to because that's just how the system is designed, right? So
Well,
what we've seen over the last first year is basically like the V1 of how auctions are designed in the intent-based bridges. But now they're making changes based on the experience of some of these problems that maybe they've run into, right? So maybe over the next year, they'll also go through the same progression as all of these RFQ systems that you've kind of talked about. So, like going from solvers to just about your protocol again, I think we've talked about enough about like how does it work, what are the different dynamics there. But I know one of the biggest problems for any new liquidity protocol or like exchange is just attracting enough order flow, right? So, how are you guys approaching your go-to-market strategy in the first few months now?
Yeah, no, we've it's a great question. It has been challenging. Or it's an area like that we view. I mean, it's an area that we view as basically making or breaking most platforms in the space. We've actually had a pretty high degree of success here, most just because like our cost structure is like way lower than anyone else's. So like we've unlocked like we're getting like our volume's been going like up quite a bit. Although it's not like a high quality volume. Like what we want to get is higher quality volume because like a lot of our default volume is just people doing stablecoin arbitrage. Like we're probably going to end up being our platform is probably going to end up being responsible for I think we'll be top 5 and a handful of other DeFi protocols in terms of enabling rebalancing of pools. And this has just basically been a byproduct of us being the cheapest place to move Tether from one chain to another. Or like, especially if you're converting between USDC and Tether. And so like this pool rebalancing has really been what's driven a lot of our volume. We want to get higher quality volume. Like we want to get these orders where people are just basically buying Doge or buying WIF or buying meme coins. And so a lot of that's just basically kind of raising awareness. We will probably end up solving those on other systems at some point, just because we want to like get all the order flow. And so if any other system starts showing there being actual demand, like we have no qualms about basically having like extending our solving operation to go like solve inside their system, place the order into ours, then solve again inside ours. But yeah, we've been pretty focused, and this is partially been inspired by like what we've seen around like where your volume's coming from. But we've been very focused on actually kind of driving up people hitting our like actual like building direct relationships with users, because it seems like that's where most people who have volume are getting their volume.
Yeah, I mean, like you cannot ignore the users for sure, and especially like I know on crypto Twitter, a lot of people talk about like abstractions and like integrations, and even DeFi's thesis has been B2B. But there's like the way people look at the ecosystem today, the mental model is kind of chain to chain, right? Like even though we talked about how most bridges just allow users to go from one chain to another, that's because it serves the market today, right? Like people want to go from one chain to another and then start exploring the ecosystem. So I feel like the front ends are super valuable even today, even in the bridging landscape.
So totally, I think that's something that we weren't really as focused on that initially. That's something we really started focusing more on. It was also important from a partnership standpoint because people don't trust things they can't use. So having people be able to directly use it and having it basically have a great GUI is something that like is super, super important from a trust standpoint. I think our higher level strategy here is like actually like more straightforward. People will only leave a platform if they want to do something that they can't do in that platform. And our goal has been basically having the most routes, again, serving routes where we think that we demand that no one else serves. And the thought process here is that over time, there will be attrition from platforms that have fewer routes to platforms that have the most routes. Like you'll have higher rates. You guys have seen this work really well with Jumper, right? You guys have better coverage than everyone else. And so if I'm running a competing platform and I have worse coverage, if a user wants to do something they can do on Jumper, they'll leave me to go to Jumper. Since there are fewer things they can't do on Jumper, fewer users like leave Jumper to come to me, even if I have much better pricing. And so that's kind of the core mechanism we're leaning on here, where like our goal is we're turning on like fingers crossed Tron and Solana. I mean, they're already live in testing, but we're likely going to launch Tron and Solana this week, and we will be like one of the only places where you can do USDT on Tron into any meme coin on Solana. And the bet we're making is that this basically ends up leading to a lot of users, like attrition to our platform over time. And as long as we can just basically keep our coverage better than everyone else's, we're not going to lose users.
Makes sense. I mean, as long as you can dominate a few routes and kind of just retain users on your UI for those routes, I feel like you will always have business, right? You do not have the chain coverage, but there have been protocols that have just done Ethereum to Solana, and then they've managed to build a sustainable user base through that. So I feel like your thesis is spot on in that way. Any last comments on before we like wrap this up?
Yeah, I mean, obviously, getting into Jumper would also be great for volume, but we can talk about that offline. No, I mean, I think we'd love to talk to anyone who wants, like anyone who either wants to work on solving inside our system or wants a solver in their system. We'd love to chat with you. Generally, we're able to basically we're getting all the top CeFi exchanges now. And so like we're able to offer essentially CeFi liquidity via solver to any DeFi protocol. And this is something that, like, as far as we can tell, is fairly unique. As far as we haven't really seen any evidence that anyone else has this yet, which is kind of crazy. But yeah, I think a lot of this, I don't think a lot of what we've talked about on this is probably going to happen for a while. Like it seems like we're still like years away from like solver concentration being viewed as an issue. I think it's like not an issue in the short term because they're all being subsidized by the teams. But yeah, so I'd say like take a lot of the predictions here with a grain of salt in that sense. Like we're probably like years away from a lot of these things happening. But
makes sense, yeah. And I really appreciate your thoughts on the ecosystem, and like I feel like you guys are building something interesting because your mental models and like how you view the space is different from anyone else I've talked to till now, right? Like some of the problems, some of the approaches that you mentioned, nobody else mentions to me, at least for now. So I feel like you will end up catering to a market that's totally different from everybody else, and that's why a Jumper integration is definitely on the cards at some point.
Yeah, no, and like I mean, I'm not sure if that's a compliment or an insult, right? I guess the proof's gonna be. But yeah, like I mean, from our perspective, the proof's in the numbers, right? So like if you disagree with anything that we're saying, just go to our platform, place a couple trades, and if you get worse pricing, come back and complain to me. But yeah, no, I think we're not even sure internally if we're right or wrong. We tend to just work in first principles, and that sometimes leads us to basically different conclusions than like what the space converges on.
Yeah, I mean, it's definitely a compliment because like there are certain facts that you can probably repeat after everyone and then like become a part of a crowd. But those are facts for a reason, right? Like everybody knows those things. Everybody wants to hear something new. And that's what I appreciate about you guys. So thanks a lot. Thanks a lot for building in this ecosystem.
Totally. And the one thing I'll say there is, like, I don't think people who disagree with us are wrong per se. Like, I think it's a question of sequencing. Like, solver concentration will probably end up being an issue, like at some future point down the road. But the more shorter term problem is probably like solver profitability. Same with like OFAs. Like OFAs definitely have a place, but there's a lot of nuance. Like people with hammers tend to view everything as nails. And so people like will latch on a solution and just kind of go looking for ways to basically looking for reasons to implement that solution rather than assessing how well that solution actually fits. And so we would like to see things be more driven by data than they are. We'd like to see things be more driven by first principles thinking than people just kind of latching on to a clever solution and then trying to force the foot in the shoe.
Amazing. I think that's a great note to end this on. Thank you for your time, and I wish you the best.
Thank you. Talk soon.